million in the stock market, which is a really fun and easy read. You could read it in a weekend, if not sooner. It's highly recommended. It's an inspiring book. Some people will say he didn't really do what he said, but I don't know. It's obviously impossible for me to know, but he was interviewed by Time Magazine, and he did show them statements and everything. So I'm going to go with the fact that it did occur what he said he was doing. But he was a dancer. He traveled the world, and he used cables to communicate with his broker. So he could be in Tokyo and get a cable, and a cable could take a day or two. So you don't have to be sitting in front of the screen. Sitting in front of the screen can be your worst enemy sometimes. Believe me, I've sat in front of the screen for 25 years. Once in a while it helps, it gets me out of something quicker, but it can hurt you too because you see every little wiggle. You just don't need to see that. His buying strategy was he called the box theory, kind of like a base, right? A stock builds a base or a box in this case. And he used buy and stop loss orders to manage his account. So if you can't watch the market, then buy and stop loss orders can help. You can use a buy stop. That's what he would do, and I'll show you in some examples. And then use a sell stop to manage the stocks that he's in. So here was his really first big winner. He had a lot of stops and starts along the way, a lot of hits and misses. And Lorillard in 1958, tobacco company, was his first big win. He bought 200 shares. I apologize. That arrow is a little higher than it should. So he bought 200 shares at 27.5. And then he got stopped at 26 on that bad reaction. So he had a kind of a good till canceled stop loss, and he got stopped, right, to protect himself. Well, the next day the stock rallied back, and he said, "Oh, that's he didn't call it a shakeout, but that was what happened to him." And so he just bought the stock back the very next day. No harm, no foul, at a higher price, right? He didn't let his ego get involved. I cannot pay more than 27.5, right? He paid 28 3/4. So he was more than willing to get in if he felt like the stock was going higher. This is a huge rule. If you sell something and then 6 days or 6 weeks later you think that stock's going higher, it doesn't matter where you sold it. It's absolute unimportant information. So he bought 200 shares back at 28 3/4, and then he put a stop again, right? Again, he's going to put a stop because he can't be there. The stock rallied, and he bought more, 400 shares at 35 and 36.5. So he would pyramid as well. Now you can see he's getting a little top heavy too, right? So his pyramiding strategy was very top heavy. And what I mean by that is he'd put more money into the stock than he put initially. And that's fine. I don't hate that idea. It's the opposite of the way we do it. We buy and then we buy more with less money, which helps you to avoid the shakeouts. I think the way that he's doing it, you can get a little top heavy and be subject to a whipsaw. But that's the way he would add sometimes. He would just put more money into the stock at ever higher prices. And he raised his stop to 36 after he saw this reaction from the cable. The stock broke from 44 and change down to 36.75. He was in Tokyo. He says, I could not know the Wall Street rumors which had driven down the stock that day. So there was a rumor that hit the stock, but he didn't know that. He just saw that it broke badly. And so he thought, okay, I better find a place to protect myself. His stop was not touched, convinced me of the stock's power. So he bought more. He bought 400 shares at 38 5/8 right there, a handful of days later. And then he sold the stock up here at 57 3/8 because he had what he felt like was a better idea, right? He wasn't going to let this stock go stale on him. He had made a big move, starting just to go sideways, and he felt like E.O. Bruce deserved his capital at that point, so he moved into that name. And here's a picture of the chart of his sell on Lorillard. It's right from the book. And in the book, it'll tell you, A is where he bought, B is where he got shaken out, etc. So after that, in the summer of 57, he made a series of new buys right there where you can see that green arrow is. And then he got stopped out of 5 trades in a row, right? And he says, I'm finally on August 26, 1957, where I'm pointing that arrow down there, I found myself without a single stock. My automatic stop loss had sold me out of everything. So you can use stops to get you out of the market. So I've marked up the chart here. The DDs are distribution days. There is a what I would call a stall day, which we would term distribution. And you can see if this was us in 1957, IBD would have the market in correction because of all the number of distribution days as the market's going down. So his general market principles saved him. He goes, I realized it's impossible for me to assess the turning points. What fascinated me was that my stop loss made such an assessment unnecessary. So if you feel like the market has just got you going backwards and forwards, and I do a lot myself, I find that the indexes, I try to not look at them, spend too much time looking at the indexes because they just wiggle me out of stocks a lot. I try to maintain my focus on the stocks I own, but his stop loss would just get him out. He had no hint that the market would slide. He just followed his rules. He didn't need predictions. He didn't need fundamentals. Didn't need rumors. He didn't need to know what the Fed was doing. He didn't need to know who was going to become president. He didn't need to know any of that. He just had his stop loss rules, and he'd gotten out on the behavior of the stocks. So you fast forward, and the market's changed, and here's Thiokol, and he noticed Thiokol was in this large, what he called a box. What would we call this? It looks, I think it's too deep to be a flat base, 46 to 39. I guess I should have done that beforehand. So it's close, 15.5%, or kind of a large cup or a cup with handle you might find. But basically, it's a large consolidation. And he bought 200 shares of Thiokol when it broke above that box. So he had 200 shares of Thiokol here. He put his stop in. A handful of days later, the stock was higher. He cabled to New York, buy 1,300 Thiokol at 49.5 stop. So when the stock was going higher, he cabled to his broker, buy more if it goes above, this box. He didn't say that, but he just said buy 1,300 Thiokol, 49.5 on a stop. So if the stock goes above 49.5, he's buying 1,300 shares. Now, again, this is very top-heavy strategy. Right? He's going from 200 to 1,500. So he's really going to jam his average cost up, but he wants to put more money into the stock at higher prices. So he ended up getting 1,300 shares at 49 7/8 on this day. So advance to later in this year. This is a chart from December of 1958. That's where he bought 200 shares. That's where he bought 1,300 shares. And all along he had his stop loss, and he's riding this winner, which is very hard to do, but he's doing it correctly, right? Ride your winners. He switched in this area. He changed the strategy, and it was very complex. You have to read the book, but it's kind of like options. He changed to rights or warrants is what we'd call them nowadays. You don't see those around too much, but basically he sold his stock and bought these rights. So he was locked up with 6,000 shares, and he had $350,000 cost average at that point. As it continued up, he says, my broker must have become nervous because I received the telegram which said your Thiokol profits are now $250,000, which is, in 1958. I didn't do the math, but I'd imagine that'd be like $1 million plus, right? So he's doing really well. He's riding his winner. He's got his stop loss, and now he's up just a ton, and he's got this dilemma on what to do, right? He says, and that's a huge dilemma that we all encounter is when to sell. He said, what should I do? The stock could rise higher. Should I take my profit and get out? It was a terrible dilemma, the old one of when to sell, much magnified because of the large amount of money at stake, right? So as the stock goes higher, the decision becomes more and more important. He says, finally, I decided not to sell. It was the best example of my new market technique, and it was anything but easy to do. I love that quote because it's true. It's anything but easy to do. But he had a rule that he said, I don't have a reason for selling a stock that's rising. So he just decided to keep it. So right in there, when he switched his his leverage to the rights, and he was able to write it up, he always kept my stop loss far behind its rise. So he wasn't worried about, you can see 34 down to 29, 50 down to 38. These are 10, 15, 20% corrections, and he's willing to sit through those for the chance to make a larger gain. So that's the way he would do it, and he'd always have his stop loss behind its rise. And in early May, Thiokol announced a split, a 3-for-1 split, and the stock went crazy. It went up, boom, 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 in 3 days in a row. Went from like 60 to 72. And he said the governors of the New York Stock Exchange decided to suspend all stop orders. They suspended it because the stock got really active, and so they felt like you couldn't use a stop on this stock. They'd taken away my most powerful tool. I could not work without it. So without a stop loss, he can't be in this stock. So he just sold it. Sold it all at an average price of 68, made $862,000 in that one, and really earned it. It's an incredible ride, from where he bought it, and withstood some wiggles along the way and sold it very well. This turned out to be the top on this move for Thiokol. So Darvas' strategy is pretty simple, and I love it. I think it's very succinct. His objective: the right stocks, the leaders, the right timing, buying them out of a base, small losses. If he was wrong, he got out quick, right? One of the things about his strategy is when he bought initially, it was always a very small position. He would call it a pilot buy, or we might hear some of the guys in house call it a probe. I know Scott O'Neill will say, he'll do a probing buy, and you're just basically like feeling out the stock. So the 200 shares of Thiokol is just a probe, a pilot buy. If it goes bad, he gets stopped out. He might lose $300 or something. Then when the stock starts to move, then he puts on the real size. So small losses, big profits. His weapons were price and volume. He was always looking for price and volume. If the stock was unusual in the paper, he would see that in the paper, and then he would cable his broker to follow that stock, to send him prices of a number of stocks that he was watching. His box theory, and then his automatic buy order, his automatic stop loss sell order.